Welcome to a new episode of the Life Science Get Together podcast. The topic of today's talk is the secrets of life science investments, especially with a focus on what is a venture fund. Back in the 90s, when I attended a commercial school, investments were basically either one of two options. One option was to put money in a savings account, which basically was the only thing that pupils in school could do. And the second option was buying companies on a large scale, like Jack Welch did with GE. In an interview a few years ago, he said that in his peak days, they acquired more than 200 companies in 1 year. Since then, since the 90s, the landscape changed tremendously. And the first time I heard about life science investments and venture funds was in 2006. It took me a couple of years to figure out what venture funds really do and how investments in life science work. So I thought it's a good idea to invite one of the best investors we have in the LSG2G network, Walter Stockinger from Hadean Ventures. Walter, welcome to the show.
Hello, Christian. Thank you for the invitation.
Hi there.
And hello, Astrid. Walter, venture funds these days are, I would say, everybody's talking about how to invest in something and how to approach venture funds. What I'm always was curious in the last years is what does it take to become a VC, an investor in life science? When I look at your CV, I mean, it was, you have tremendous experience in various fields. So how does it actually work to go from a PhD at the Medical University of Vienna, then a few years later being one of the most famous venture investors in Europe?
Well, Christian, I don't think that I really knew what venture capital was before I actually worked in venture capital. So it was definitely not the plan to end up in venture capital, although I have to say I'm very happy. It is a very exciting industry to work in. And I should also say that in life science, at least in life sciences, and you know, venture capital exists more or less by industry split, right? There are technology funds, there are fintech funds that invest in the finance industry, and life science funds like ours. In our field, pretty much everybody has got a PhD, and some of our colleagues have an MD. So everybody has one. But on the other hand, of course, there are very few PhDs who end up in venture capital. And like for most of them, for me, it was coincidence. I was really pursuing a life science career. I was a scientist until I was at the age of 35, I think. And I was working at Harvard University, and I met somebody who worked actually for the Boston Consulting Group. And at the time I realized BCG is a fantastic firm. It's the best in the field, and it's an opportunity. When I got an offer, I realized it's an opportunity to learn something completely new. So I was 35 and I decided to do something absolutely new to me, which I admit I had no clue about: strategy consulting. And a few years into strategy consulting, the same thing happened again. There was an opportunity to work for a venture capital fund. It was a very big fund. They did open at the time a London office, so I also had the opportunity to be one of the first investors there. So I joined that firm. I left consulting, joined VC, realized that VC really is a perfect combination of science and business. And ever since then, I have been in venture capital.
Walter, we hear so much about venture capital, VC, and what exactly is a venture fund?
So a venture fund is actually not what I'm employed in. A venture fund is a pooled investment vehicle. So, you know, if you wanna understand the details, if you wanna understand how this works, we are a fund manager. We are managing funds. So far, we are managing one fund, but we are about to raise our second fund. And these funds are then the vehicles that invest into startups. A fund is a pooled investment vehicle that allows individuals to get exposure to the startup world and do this in a pooled fashion. Investing into a single stock is, even for us, it's just too risky. I personally, we all could invest into biotech stock. I think I don't dare doing that. I buy the index ETF on the stock exchange because I feel like investing into the life sciences, you really need to do a very deep due diligence with lots of people who have the know-how. And most investors who want to have exposure to that field don't have that know-how. So what we offer to them is they can buy into the pooled vehicle, and we will make a number of investments. Their single investment will then be spread over a couple of startups in the industry, which reduces their risk, first of all, because it's a spread over several startups, and secondly, because we are experts in what we are doing.
Walter, I have another question to the life of a venture fund and the team of a venture fund. When I look on the retail side, so these days the research since GameStop, I know mostly happens on Reddit. So people go on, let's say, a chat group, exchange information, and then decide together to invest in a stock. How is the life of the team of a venture fund? Is this comparable to the life of a retail investor, that you say you go a little bit on the internet and then decide what you buy? Or are there any differences, significant differences to that?
So no, we are a part of private equity. So what we do is we invest in stocks, usually, mostly. We invest in stocks that are not listed on any stock exchange. Those are private firms. They have been founded typically in our industry by experts in their field. They have been founded usually by scientists. Interestingly, if you look into more mature markets like the United States, you will see repeat entrepreneurs. But you have to think about it that way. Everybody who starts a company, or almost all people who start companies in our field, are very experienced in the industry before they start their first startup, which means they're already in their late 30s, mid 40s, maybe even 50s. Now, running such a startup takes 4, 5, 6, 10 years. So there are very few of them are repeat entrepreneurs. Most of them are first comers, and at least from the founder teams. And so we meet them at dedicated conferences. And they, of course, at the places where they work, they usually know they're incubators, for example. There's a network, of course, they network amongst each other. So you Google the internet, they Google the internet, they find out what are the funds that are currently active. So they find us usually over the internet or through network, or we find them at dedicated conferences.
Also mixed expectations really when founders actually approach VCs. Can you give us a little bit of an insight what the business model of a fund is? How does that work?
So, so the business model of a fund, and again, you have to differentiate between the fund and the fund manager, right? So the business model of the fund, there is no business model because a fund is a pooled investment vehicle, as I said. So the idea is that people can lower the risk of their investment by investing into the pooled vehicle that then in turn invests into several startups. We as fund managers, of course, we do have a business model. We have an operating company with employees and everything that comes with that. And we manage these funds. We get a salary for managing the funds. And the real upside for us is, of course, if those funds do well, because we also participate in the profit of the fund.
And you mentioned already, that sort of there is the business model of managing these funds. So how does sort of the management company side of things operate in comparison to a normal, so a usual company that you would see?
I don't think there's much of a difference. We are a service provider. We are providing a service to two groups of customers, if you want to call it like that. We're providing a service to investors by creating funds and by allowing them to invest into an industry they don't know it mostly as much about as we do. And that is one part of the business, building relationships with these investors. That's a very long-term relationship and enterprise to work with them. Hopefully it's a long-term relationship. And then we have on the other side, we are looking for companies that we can invest into. And we work with these companies. First of all, we try to find the best technology. That is usually and mostly a selection of the technology. So we review those, we do interviews with them, we do interviews with experts in their medical fields. We gather our collective knowledge in this space. And then based on that, we go through several rounds of due diligence. And in the end, if we decide as a team that we want to make an investment out of one of the funds, then we execute that investment, which is also quite a process because it's private investment, involves sometimes hundreds of pages of contracts that need to be drafted, that need to be reviewed, that need to be negotiated. So that's also part of the business.
Yeah, my experience is also always that founders forget, that you're not just this big bag of money, but that you actually also have investors as well, that, as you rightly say, you're managing the funds for, and that actually you also need to be accountable to these people as well. So when you're actually doing all this due diligence, as you described, and which is can be quite an extensive process, then basically at the end of the day, it's also sort of it forms the justification of why you made the one or the other investment decision.
It's hard. I get it. It's hard for founders who they have less optionality than we have, right? The founder has an idea, and that idea needs to work for the founder. Maybe he has a second idea in his life. So we see 300 to 500 investment opportunities per year, and we invest into 3 to 5 of those. So inherently, we say for every yes, we say 100 times no. And that must be tough on the startup side. I get that. Not all ideas are good business models. So, and some of them are just better than others. And, the better is the enemy of the good. So we will pick, the best we can. We hope we pick the best. And then there will be many of those. And I always tell my colleagues, if we look at 510 of those are success, we definitely have said at least to 5 of those, we have said no. So if we say no, that's not a verdict on the opportunity, right? This is just that we have at that point in time, for various reasons, decided not to invest. Although I think, it is worthwhile for founders who do this often for the first time or only for a couple of years, who may not have had the strategic exposure to what it all entails to run a startup, to raise funds, to bring a product to the market, or to sell a product to big pharma. It is worthwhile considering what your VC counterparts tell you in terms of strategy. They may have good ideas sometimes.
I definitely believe that, Walter. You're talking a lot about investments in companies. When I look at the industry, I see many players in the field. So, for example, there are pharma companies like Pfizer, like Boehringer. Then we have manufacturing companies who solely focus on manufacturing products. Then we have service providers who, tax consultants, for example, auditors, all various kinds of services that are offered in exchange for money. When you talk about investment, what exactly are you looking for in a company? What does a company need that you consider it worthwhile investing in?
Yeah. So this is now about Hadean Ventures, right? Because we have, like every fund, we have our own strategy. I think compared to many funds, we have a very broad strategy. It's basically any health technology that is based on life sciences. But then we have also our personal preferences. Then most funds have a geographic focus area, as we do, and it's a combination of those criteria. I mean, I'm with respect to Hadean, our firm, we're an expert really in for certain parts of Europe where the comparably little venture capital exists. This is the Nordics and Germany, Austria in particular. So there are not many other funds for whatever reason, probably historic reasons, while if you compare the scientific output of these areas, it's fantastic. I mean, it's absolutely world leading. What we do not have, and that is reflected in the management teams, we have not many experienced entrepreneurs or, team members in startups that have done that before. They come from big pharma, they come from research, but they don't yet. They have to learn the strategically what they have to aim for strategically, and they have to learn what the various parts of their business that they are playing in now are. For example, fundraising, right? Which is an experience you don't get anywhere else, but if you are an entrepreneur.
I mean, I think you touched upon a very important part that basically every fund sort of has it also written in their documents that they have a specific focus on what they're investing in, because this is sort of the promise that they gave to the investors who in turn invested into the fund. So let's assume a company actually did their job well on looking through different types of investors, and then they chose you because they said, like, okay, this seems to be a fitting area for my company. What is sort of the documents that they would need, or what should they have ready and prepared when approaching you?
So Astrid, I'll try to answer your question. If I don't, then but I think at this point, at least in time, let me just to be clear, right? At this point in time, there is no excess of capital for startups in Europe. So the situation that an entrepreneur has the luxury of saying, I want to have this offer or that offer, that is rare. So my recommendation to all entrepreneurs out there with life science technologies, reach out to as many life science funds. Their business is to filter. Do not filter, right? Prepare your materials. It's a question, right? I'll get there. Get your materials ready and try to reach everybody. We depend on good ideas. We like it when we get ideas in. We have, we are experienced. Sometimes we very rapidly see, that's not a good idea, or, something is missing. But if it's a good idea, we will pick it out, even if the material that you submit is not perfect. In fact, personally, if somebody presents this a super slick document, then I always wonder, is this only marketing, or right? So I prefer the documents, the PowerPoint presentation. Ultimately, it is right. I'd rather see that they have really done everything scientifically and on the step to a product, with all the necessary steps, and the presentation material, the information material not being perfect. We don't, the easier it is for us to consume, the better. But the most important part is that they have, dotted the I's and crossed the T's in their work, not in their presentation. But usually it's a PowerPoint presentation that explains the principle of the idea and the product that they have at the stage where they are and what they want to do and what they need.
Walter, for reaching out, I have one question. I heard so many opinions about the right timing to approach a venture capital fund. So one opinion is when I have only 2 weeks cash runway, it's early enough to pick up the phone, call a VC, and they get the money immediately. Other people recommend talk to VCs all the time. So find out what they want, approach them, and be proactive, and don't call them only when you need money. What is your approach? Is it annoying to you when somebody who is not actually fundraising is approaching you? Do you prefer having the call very close to the cash out of the company? How does Hadean Ventures handle this?
So the short answer is, and I can say this out of personal experience, the short answer is you never stop fundraising. You're always fundraising. It's building a relationship, building trust, giving the VC. If you give the VC an opportunity to follow you, even, we're following companies that are too early for us. I appreciate, when they reach out to me, when they tell me where they are, I tell them very early on, too early, but stay in touch. Please do that. Never lose touch, and keep me interested. That's the same for us as a fund manager. We have a dedicated group of people that fosters the relationships with our investors.
And in terms of due diligence, just before we had it just a moment ago, I mean, what are the sort of things that you're looking for when someone is approaching you? Are there any certain topics where you feel like, oh, this is really super important to me, this needs to be already solved? Or are there also topics where you say like, oh, well, we can probably talk this through together with the company and help them? Or in turn, are you a very active investor, or rather more like do your thing and we only get involved when it's really problematic?
So, I mean, I said we are a specialist for a certain region, right? And we very often encounter teams that haven't done this before. As a consequence of that is that we are very involved, that we try to help portfolio companies. We are always on the board, but I give you an example. There's one portfolio company that is very close to my heart. It's in that diagnostic space. It's a fantastic opportunity, but it's very difficult in that space to raise money because many life science funds, we don't do that type of technology. And so we have reached out to 60 or 70 people out of our network, and we keep track of these. This is managing the conversation with 70 people or groups of people. That's an intensive piece of work, right? And that's what we have done on top of what the company is doing. So yes, we work very closely when the companies need fundraising, when the company thinks about the strategy going forward, what types of trial would create the best value for the buck. And so we prefer to be very closely involved, and we like it even better if the company knows everything better than we do, and we end up learning and not teaching.
Walter, when I moved into the life science industry, I worked the first time for venture-backed companies, and before I was in merger acquisition in other industries. And basically, the training was when you build a company, you build it for eternity. So it's something like Jeff Bezos did with Amazon, I guess. And when I entered the industry, let's say it struck me like lightning because I learned a new term, and this was an exit. And the VC started telling me at some point in time we need to exit and sell the company. So what actually is an exit, and why is it so important for VCs?
Well, the reason is that we have closed-end funds, which means that our funds only have a certain period of time to get new investors into the fund. Then the fund is closed. The fund is not traded. For most VCs, the fund is not tradable. You own these shares until the end of the lifetime of the fund, and then the fund has to be dissolved. That's the normal life cycle of a fund. In fact, a normal fund, if an off-the-shelf structure, would have 5 years, where the first 5 years where the fund is trying to make investments into new companies, and an additional 5 years where this fund is further investing into existing companies and then starting to trying to sell these companies. And in the end, after 10 years, and sometimes it's a bit extended, at the end of that fund has to be completely dissolved. The company disappears, that the fund vehicle disappears. And for that reason, you always need to have a way to sell the shares that the fund owns. And ideally, like my old boss said, real VCs do M&A. So ideally, you sell these shares for cash. Obviously, in particular in the United States, you can create lots of value by putting it on a stock exchange, although an IPO is not an exit, right? Because you still own the shares. Only if there's enough liquidity afterwards that you can sell them, you can get rid of your shares. But that's an alternative. But at the end of the day, we are obliged to return the money that our investors gave us. We are obliged to give it back. So, since most of these shares are not tradable, we have to give back cash. And that is a deal that is clear. I don't think it is surprising to entrepreneurs anymore. It was 10 years ago to some entrepreneurs. Most entrepreneurs who reach out to VCs nowadays do know that an exit is a necessity, and that it's not immoral to try to get as much money for your shares, for your company as possible.
That's true. That's true. But let's stay a little bit at this point and maybe go a little bit back in the conversation to what the company must have prepared, not in terms of the material that it's presented to you. Let's talk a little bit about in terms of the investment case. How should the case of a business model look like that it becomes attractive to an investor? Because I believe there are many cases on the market that are great, that are good cases, but not really in the sweet spot of an investor. So what's your opinion on the perfect development and business model that Hadean Ventures is looking for?
Okay, so because we're looking into several different industries, if you differentiate between medtech, diagnostics, pharmaceuticals, or therapeutics, it's not the same in each of those. But about half of what we do is in pharmaceuticals or in therapeutics. So maybe I focus on those. We are looking, and I guess this is one of the things that we do different than other funds. We are looking for something that de-risks this investment compared to the industry standard. So that is something that we look at. And then it can be something very early. It can be a company creation. It can be something very late. We did a crossover. We participated in a crossover round just recently of a fund of a company that then went on to have a Nasdaq IPO. And so we're looking for the right opportunity where we think that the risk profile and the return profile matches. Now, I know for a specific listener out there that doesn't help much. It is ultimately our experience in the field that we know which type of technology can be sold under which circumstances at which stage. This is different from oncology product. If you compare oncology products to a, let's say, diabetes product, the paths to the market are different for a chronic disease that is not lethal, like type 1 diabetes or type 2 diabetes. Versus, Wilson disease that, is very severe and leads ultimately to death. So there is no principal rule for how an asset should look like. What we absolutely require, we as Hadean Ventures, is that it's unique, that we believe it can be sold with not at a certain stage of the development, but within a certain amount of time. And that may be for certain assets post phase 1, from certain assets post phase 2, and some assets you will have to develop until the end of phase 3. It just depends on where you play. We want to deploy our money into clinical development. We do not deploy our money into research. So being close to the clinical development is, one of the simpler guidelines that I can give to the listeners with respect to Hadean. We would not finance research. We do not finance lead developments or stages of small molecule development, like lead identification, lead development. That's not our business. We think that pharma companies are much better in doing that.
How does your internal decision-making process actually look like? So what kind of steps do you need to go for internal? Because as Christian mentioned before, there are sometimes expectations that, I need money in 2 weeks and it will miraculously appear when I start talking to VCs. But that process actually takes a while. So how does it look like at Hadean?
Yeah. So due diligence is it is a structured process in our firm, yet it is to some extent informal. We start getting initial, usually a PowerPoint deck. We look at that, and many of the opportunities we can exclude for various reasons by looking at the data that's disclosed in that non-confidential deck, or because other factors. And if we like it, we collect enough data. This may be the data that's in the presentation, or it may be data that we then collect with calls or interactions with the founders for a first review. In our firm, everybody in the firm, so we are a team of, I think, 10 investors, investment professionals, 8 to 10. Everybody is in every meeting, and every company is discussed. We have a champion. usually the distribution of the deals happens coincidentally, or people find them and think, I want to pursue this. So there has to be somebody on our side that really wants to do that. And then that person presents an internal presentation where they explain it in our language to us, and it goes through that first, what we call a pre-screen. And internally, we decide then whether or not, we want to keep it a pre-screen and there's more information, or we make it a so-called B proposal. That's, an internal lingo, but it basically means this is a company that we think could become an investment opportunity. And at that stage, it stays usually for several presentations and rounds. So usually an hour to 2 hours presentation of the champion. Lots of questions, challenging questions. We are a curious team, so we want to know, and then that person goes back and answers these questions and finds out more things, presents those. Of course, there's a certain list of things that you always do. You always look at the regulatory environment. You always look at the CMCs, or the manufacturing of the product. Very different for a small molecule than a biologic, and the so-called preclinical package, clinical talks, different requirements for different types of indications. So that person, the champion, is going through several rounds with the person. Usually it's Wednesday morning, and meetings take forever. And that person presents, takes home more questions, and then goes back for another week or two to answer these questions, and comes back with the answers. At some point, but Corona has changed things. We always had the management team come over at a certain stage and present. Usually our team at that stage already was kind of informed, the whole team. And it was more of a, learning more about the people, but also about the asset. And then we would start negotiating a term sheet. And that usually comes in various forms that, depending on the situation, that can be a very short form or it can be a very long form. We decide internally what we think strategically makes more sense. And we make evaluation. We make a very comprehensive valuation. It's a so-called risk adjusted scenario, NPV, that we build. And we check, with the expectations of the company and what our models tell us, whether or not it makes sense, and that's our valuation proposal. And we negotiate the term sheet. If that comes to a conclusion, then you usually sign the term sheet, and you move on to contracting, where a law firm is hired to develop the contracts. And that usually, at that stage, we also do a legal due diligence. We have a law firm look at all the employment contracts. Are there any risks? Has the company pledged any of the assets to somebody else? Do they own the asset? Have they paid the IP fees? Things like that. So legal due diligence. We also do an IP due diligence. And hopefully that leads to contract signing and the wiring of the money.
What are the most common pitfalls that a deal would actually not go through?
That the asset is that we think the risk profile of the asset is not what we originally thought it was. It does sometimes happen that we can't get the syndicate together. I think I wanted to say this earlier. So in Europe, there is not enough capital for startups, in particular in the life sciences. So deals are not competitive. There's not too much money, which basically means it's a good thing, because when we like a deal, we will help the company to raise money from others, and other funds that have worked with us know us, and it really gets the company much further if we have, for example, given them a term sheet. It's much easier to raise money once you have, the first couple millions from a VC that then looks for a syndication partner. And multiple VCs for the company means security for follow-on funds. Hardly a round is the last round. Most of the cases, a round leads to another investment round.
That's a good point that you mentioned, syndication, and it really, I went through this process from the company side multiple times. So it's really true. Once you have the first term sheet on the table from a serious investor, things become much easier. I completely agree to what you say that capital is scarce. There are many opportunities on the market in Europe, but not enough capital to fund these opportunities, especially in drug development, which makes fundraising quite interesting from the corporate side. You recently founded Hadean Ventures yourself. And I'm curious, how is the process of starting a venture fund? Is it similar to starting a company, or is it much easier for venture funds that you just say, I want to have a fund and the money flies to you through the window?
Um, I would like to say it's much more difficult. But the reason being that differentiating in a service business is much harder than differentiating with the technology. Right? The technology may be differentiated or not. That's a property of the technology. It is much harder to argue to an investor. And founding a fund manager or the fund that is associated with that fund manager, that means we go out, and we went out for 1.5 years, without a salary, trying to get to a first close for our fund, number one. And we had plans doing this many years before we actually started. So I remember the first time my partner and I sat together was in a small pizzeria in London in, I think, 2012. And we started fundraising in 2016 and December 2017, we had a first close. And we kept fundraising for fund number one for another 1.5 years. So that was in a way, I think it is harder than a startup because we don't have a technology. We just have, our pretty faces and our convincing story. We don't have a track record if you're not fundraising for fund 4 or 5, right? We have our track record in our previous firm, but it's always a much harder proposition for LPs. So our investors, we call them LPs, right? It's much harder for them because we don't have this asset that they can do their due diligence on. It's us as a team, and we have to be credible that we can what we promise them.
So what is your USP over other sort of funds in this space in the life?
Besides the fact that we have an excellent team, in particular, my colleagues, we had the opportunity to pick the best from our previous firm who were interested enough to working with us. So we are not first-time investors, right? We are differentiating us in a way that we are focusing on regions where fewer venture funds are present, and that we are very much risk-driven. So we do not want some funds you'll hear say, look, it's not a new mode of action, it's not a new modality. Maybe the IP has a weakness here, we just don't do that. Right? We try to make this work if we think that there is a substantially lowered risk in the development process of that asset for whatever reasons. So that's I think what we do differently than others. So we're looking for these opportunities where we think the risk actually is much lower than if you just look at the average success rates of drugs in that space.
So after closing the first fund, your faces are still pretty. You have a larger team right now. And what I got from the industry, you also got your first successes in, like Demis Bioscience, for example. And now you're in the process to raise another fund. So I'm still curious on how that works for funds. You have a better track record than raising your first fund. And also, I think the Corona crisis, when it comes to money deployed into life science, has become much better probably since 2016 and 2017. How is your experience during the fundraising process for a new fund? Are my assumptions right? Or am I, let's say, probably a little bit too positive on the capital situation in Europe?
So frankly, I cannot tell you. And the reason is the following. As a fund number one, you have no follow-on investors. You go with the people that you've never met before. And that is still the case if you are out there as a new venture team. You have fund number one. You need to get these investors Fund number ones are often actually better performing than others. So that happens, but most investors will say, we don't do a first-time fund team. Now, we are out fundraising number two because we started thinking about fund two only 3 years into fund number one. Usually you wait for 5 years. And the reason was that our investors asked us to do that. So our investors asked us, so when are you going to start fundraising fund number two? So fund number two, the fundraising currently only is within the existing investors, which have the first offer. And we will get, the future is always uncertain, but the way it looks like, we'll get to a first close with only existing investors. We will then ask a certain group of external investors to come along if they want to. But that will only happen after we have done our first close. I mean, look, we never say no, right? But we think the best way to go about it is to demonstrate that our existing investors have a strong interest after being in fund number one to come along in fund number two. And that should happen within the next 2 or so months. And then, as I said, then we'll reach out to a broader audience and we see if we can get some new investors in into our fund number two.
So is fund one, number one, already fully deployed? So is it fully invested already?
No, you never deploy. At the end of the investment period, right, which is the first 5 years, you still have to reserve a lot of money for follow-up investments into the companies. So no, it's not fully deployed. There's sufficient capital for we have room for 1 or 2 more companies. We are closing right now. I think we're about to sign contracts for 1 more investment. And that will bring our portfolio, is it 11 or 12 now? I forget. And then we have sufficient capital for these companies to keep investing into these, but we will not invest into new companies once we have fund number two. Then fund number one, in terms of building up the portfolio, is done. There's also no way to get into fund number one anymore, right? As a new investor, you can come into fund number two. And then we start investing into new companies, which we already have built up in our pipeline out of fund number two. But no, the capital is not deployed. There's sufficient capital for follow-on investments.
That's good to know. So you're basically still looking for companies. I wonder, what's the best way to reach out to the team of Hadean Ventures? Is it just a LinkedIn message, or is it going to a conference? What way of communication for the first contact do you prefer?
So I have to say I didn't check, but last time I checked, our email addresses were on our website. So it is very easy. You Google my name, you'll find my email address. Send me an email. Send it to anybody in our team. Maybe even better to some of the we distribute it internally. It doesn't matter who you send it to. We make sure it's put into a pipeline, and usually, actually, the person who receives it has a very quick look at it and says, I need to prioritize or not. Then it goes into a pipeline. Will be if it isn't already taken by somebody, it will be assigned to somebody, and that person then should do this within a certain period of time. Should have a first look. Having said that, nagging always helps. So,
what's your average ticket size, actually?
The ticket size. So we want to allocate over multiple rounds. Out of fund one, about 8 million euros for a single portfolio company. Out of fund number two, let's see. We hope that the size of fund number two is going to be a little bigger than fund number one, so the ticket size will probably increase. The number of portfolio companies is probably not increasing so much, because there's only, if we would do that, that means you'd have to substantially increase the team, because we work with such an intensity with our portfolio companies that you cannot handle more than a certain number per senior person in the team. So same amount of companies, probably a bit higher allocation per company over several rounds, and we can do a very small round, which would for us be 500,000 as the first ticket, or a bigger round, which is 3 million at the first as a first investment, but it almost always comes in multiple investments.
So is it also tied to certain milestones that a company would achieve? Is there also a mechanism that you have in there, or you just committed full at the beginning, said like, no, okay, we'll deploy it over, several months or whatever is the time period, regardless of any kind of milestones in between?
No, absolutely. We do not commit the full amount without the company achieving certain milestones. It can be committed, but that commitment then depends on them having a very clearly defined set of achievements within a certain period of time. So usually the money comes with milestones that need to be met for the next investment round.
Walter, one final question from my end. We had a time when we could meet in person, and let's just assume that it happens again in the future, that there will be conferences. And let's just think about the situation that's typical to, for example, BioEurope, that you bump into a life science entrepreneur. You are in a hurry to the next meeting because you have a full back-to-back schedule already planned. And the life science entrepreneur asks you just one question and say, please spare me 1 minute and give me one advice. What is the most important thing that I need to consider if I want to create a successful life science company? What's your opinion?
But it has to be the right asset, and you have to have the right strategy. It's a combination of asset and strategy. And as an entrepreneur, the investor is your friend, not your enemy. I'm not saying that everybody's a good person, right, on our side of the table, but usually we have no interest in the entrepreneur not being successful. So we usually pull on the same string.
Walter, many thanks for your time, for the talk. It was very insightful, and I'm very happy to see you. I wish you all the best in raising and closing your second fund, and also all the best to your team.
Thank you very much, Astrid.
Thanks a lot.
Christian.
Have a great day.
Thanks.
Bye.
Thanks. Bye-bye.
Thanks for listening. Please share the podcast and make sure you've subscribed. Have a great day.